speaking to CNBC TV 18. First, I wanted your thoughts on the Indian market because today we're rejoicing the passage of the GST bill. As a foreign investor, how would you look at India now?
Well, there are different aspects. First of all, I'd like to point out that I know quite a little bit about taxation because I studied under a professor who had been the brain behind the introduction of the value-added tax in Germany under the then Minister of Finance, Mr. Erhard. And I also wrote the thesis about the financial reform of Robert Peel, who in 1842 introduced an income tax as a permanent measure, which was at the time just 7%, by the way, and only levied on incomes that were very high for the time. So I've studied taxation, and the introduction of the GST in general is positive, but I also have to say, I personally, I'm against any tax increase. So that if the GST is a tax increase because some states will still impose sales taxes, then it's a step backward instead of a step forward. So there are many details that still need to be known before we can say blanket it's positive or it's negative. What is positive is that Mr. Modi managed to push through a reform that essentially boosts his prestige and his pro-reform agenda. But the details are not yet known.
Okay, details are not yet known. Mark, hi, good afternoon. The other big issue for the market has been the global liquidity, and my mind keeps going back to the conversation that I had with you at your house in Chiang Mai about more money printing, and you said central banks will keep printing money. At what point do you see this money printing stopping the market from rising, almost on a week-on-week basis? Do you think we've seen start of that with the bit of correction that we've seen in global markets, or do you see more, bubble-like formation in global equities?
I think money printing in the one or the other form will continue. Now, increasingly, central banks and fund managers and, say, treasury departments are talking about helicopter money. Basically, helicopter money is you don't just buy securities that are traded in the public market like treasuries or sovereign bonds and equities. Like in Japan, the Bank of Japan bought ETFs of Japanese shares. But you essentially distribute money to each individual. It's distributing money is like a tax cut, but whereas the tax cut only flows to people that actually pay tax, say federal tax in the U.S., and roughly half of Americans do not pay federal tax. So that's essentially tax cuts are not touching everybody. But if I send a check to every man, woman, and child for $10,000, then he gets that money. And he can then go and spend that money. And for a month or two, that obviously boosts economic activity unquestionably. But then comes the question, who finances this? So what can happen in this helicopter money is that the Treasury issues bonds that investors would buy, or the Treasury just gets the money from the Federal Reserve. So that's another form of money printing.
Okay. So what kind of asset allocation would you advise for the investors who are watching you right now, Mark? Because I know that you've been a big bull in gold, and gold has been one of the hottest investments or hottest asset classes these days. Between gold, equities, bonds, where there's a lot of money being made these days as well, what would your preferred asset be for the rest of the year?
Well, as you know, a famous hedge fund manager in the U.S., Jeff Gundlach, he expressed the view that you should sell everything, including your children, because there's nothing to buy. Now, philosophically, I agree with this view, except the following. Let's say you have $10 million and you sell everything, your shares, your properties, your bonds, and your gold and commodities. What do you do with the money? So you can put it in a bank, but what about if that bank goes bankrupt? Because if you're really bearish about equities and bonds, then the chances that there will be a financial crisis is high. And say if you have your money with Credit Suisse or Deutsche Bank or any European bank for that matter, there is a risk, including also U.S. banks. So I say to myself, the madness of central banks can go on for a long time. The U.S. Treasury and the Federal Reserve, essentially the Federal Reserve, has stopped with their QEs for now. But it's been replaced by the ECB and the Bank of Japan that essentially buy assets worth $180 billion every month. And I'm quite sure that QE4 in the U.S. will follow sometimes when the economy weakens in the one or the other form. Because the treasury departments of countries and the central banks, they of course work together. So in this environment, I still want to own some precious metals. This year, silver has outperformed gold, and in the last couple of weeks, platinum has outperformed gold, and of course the best performing shares were gold and silver shares this year. No group comes even close to it. And I would hold some precious metals. I would hold some real estate. I think there are some problems associated with real estate, like real estate taxes and so forth. But say in India, there's still plenty of opportunities in real estate, especially in terms of families owning second homes in resort areas. And then I would own some equities. And when it comes to bonds and cash, I agree with people who say U.S. treasuries are unattractive. Yes, that's correct. But what would you rather own? A 10-year Japanese government bond at the negative interest rate, or a 30-year Swiss franc bond at the negative interest rate, or a 10-year treasury at the yield of over 1.55%. So you understand, the treasury is not attractive, but relative to other sovereign bonds, and there are $12 trillion worth of bonds trading at the negative yield, relative to these bonds, I would say treasuries are reasonably attractive.
Okay, that point is taken. Mark, final question then for Indian market. For Indian stock market, do you think investors will still get positive returns and will still get, the returns in, say, double digits over the next 2 or 3 years? Is the market still attractive?
Well, when I had my last interview with, I think, you, I expressed the view that in the next, say, 5 to 10 years, the Indian market would outperform the S&P 500. I still maintain that. We don't know exactly how far the market will move. The Indian market is also dependent on the exchange rate. Say if the rupee weakens significantly, then the Indian market adjusts upwards. If the rupee would strengthen against the dollar, then the market is less attractive in rupee terms. So these are all factors. But in general, I think the Indian economy, and we can debate, will it grow at 6% per annum for the next 5 years or only at 4%? It doesn't really matter compared to the U.S. that has a 1% growth at probably best. maybe even less. And to Europe, that has no growth, I think the Indian economy is performing reasonably well, and that equities are reasonably attractive.
Okay, Mark, we leave it at that. Thank you for stopping by and speaking to us. So that's Mark Faber at his humorous best. He says, as far as world markets are concerned, you need to sell everything, including your children, because there's not much to buy in this market. But India will continue to outperform a lot of global markets. Let's take a break.